Okay, well, we're very lucky to have Ellen Brown, and she's here to talk about the financial issues around the crisis that we've got. She prefers to be called a financial blogger, but I think that's slightly doing her down. I think she's an expert, and I hope Ellen's going to be patient with me. These are the sort of questions that I think a lot of people are going to be asking. So, Ellen, it's all yours.
Okay, thanks, Ian. Well, I've written a book called Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free. The shocking truth about our money system is that virtually all of our money is created by banks, not by governments, as everybody thinks. The way they do this is whenever they make a loan, they just write the money into your account. And then when you write a check on that account, it has to clear. And for that, they need money coming in. They need deposits coming in to clear the checks going out. But you're not actually borrowing that depositor's money as they make it seem like you are. The depositor's money is always there. You never walk into a bank and say, I'd like to withdraw my money, and they say, I'm sorry, we just lent it to Mr. Smith, come back in 30 years. Your money is always there, even though it's supposedly been lent out to someone else. So what the bank does, and the way they create money, is that this is the textbook model where they get a deposit in, let's say, of $10,000, and then they're supposed to hold back 10%, so that would be $1,000. So then they can make a loan of $9,000, and then that $9,000 loan becomes a check which goes into another bank, and then that bank calls that a $9,000 deposit, and then they hold back 10%, and they can make a loan of $8,100, and so forth. So $10,000 becomes $100,000, but all along the $10,000 is still sitting there in the first bank. The depositor can still walk in at any time and say, I'd like my $10,000, and they'll get it back. And if the bank doesn't have enough money to cover all the claims against it, it will borrow either from its own depositors or from other banks at the Fed funds rate in the US of 0.25%. In other words, they can get the money for almost nothing, whereas governments and the rest of us have to pay quite a bit for this money. Or they can get it from the money market. There are several sources where they can get it. So it's a great big shell game. And the reason it's a pyramid scheme and parasitic and not sustainable is that because banks create virtually all of our money, and they issue only the principal, and then they take back principal and interest. They're always putting out less than they take back. So they put out 10, take back 11, put out 11, take back 11 and a half. So there's never enough money to actually pay what they lend. And therefore, either somebody has to default, which eventually, you'll get this big bubble, and then there's not enough money out there, and then suddenly you have a wave of defaults, and then the people with the money can go out and buy all that up very cheaply, and then this repeats over and over again. Or you have to keep inflating the money supply, which is what they do. This whole process goes back to the 17th century goldsmiths who would take in people's gold for safekeeping, and they would issue these little paper notes called banknotes. And they discovered that they could issue 10 times as many banknotes as they had gold, because people only came for their gold 10% of the time. So they could lend out all these banknotes because people preferred carrying the banknotes. They were safer and easier to carry around. So the goldsmith turned banker could lend out 10 times as many notes as they had gold at 10% interest. So every year they could be making 100% on this gold that wasn't even theirs. So obviously they became very rich, and somebody else had to pay for all this, so the other people were getting poorer and poorer. But the wealth of the goldsmith turned bankers then put them in a position to lend to the king on condition that the king would allow this new bank, the Bank of England, to issue the national currency and do the same thing, where they were issuing many times more notes than they actually had gold in the vaults. And so that was the basis of this, the beginning of this central banking system that we have now. Okay, so the American colonies did not have gold, and they didn't have many British bankers around. So they were issuing their own money, and this worked very well. And the colonists were becoming quite independent, and that alarmed the Bank of England and alarmed King George. So they put a stop to this, and then the colonists rebelled, and we had our American Revolution. But the bankers got back in by stealth by setting up these private banks, the first U.S. bank, second U.S. bank, the National Bank Act, and then the Federal Reserve. So we still have a bank-issued currency, even though we're theoretically independent. Abraham Lincoln broke away from that system, but there was an effort to trap the North in usurious debt during the war. That's what they do with wars. You know, you're desperate during a war, so you'll borrow, and that's how they get countries trapped in debt to the international banking cartel. But Lincoln foiled the bankers and issued his own currency, just as the colonists had done, and won the war. But of course, he was assassinated, and that program was curtailed. Meanwhile, earlier, Nathan Rothschild, who was the big banker of England, had famously said, allow me to issue and control a nation's currency, and I care not who makes its laws. And that's basically what they've been doing for a couple of 100 years, is controlling the currency, and in that way they have gotten control of governments. So the next rebellion after, I'm just going through the history here, the next rebellion after Lincoln from this system was the Commonwealth Bank of Australia in 1912. They had just gone through a heavy depression, and so they decided that the private banks had failed and that the government needed to have its own bank, which it did. And this again alarmed the bankers, so they made sure that they got one of their own as the head of the bank, Dennis and Miller, but he saw the potential for the country and knew how banking worked. And so he used this bank to just issue national credit and did remarkable things. He expanded he developed the whole economy with, you know, seaways and roadways, and set up a shipping line which actually competed with the Bank of England shipping line. So they did remarkable things just by issuing credit without backing it, but without borrowing, without acquiring the money first. And they funded World War I, their participation in World War I that way. This totally alarmed the Bank of England, because that was how they were keeping control of their colonies, was they kept control of the capital. They were the lenders, and particularly during war, you were supposed to turn to the mother country for your loans. So in 1923, Dennis and Miller died suddenly of a heart attack, and the Bank of England imposed a committee to take charge of this bank, and the committee, of course, could be controlled from the City of London. And then they got the bright idea that they would have the power to issue the national currency transferred over to the Commonwealth Bank, to the central bank, from the Treasury. So the Australian Treasury could no longer print its own money. It had to borrow from the Commonwealth Bank, and the Commonwealth Bank was now under the control of the Bank of England. It was like a junior partner in this new central banking system that they were going to set up. And they started on the whole austerity thing, that an emissary was sent out from the Bank of England. This was Otto Niemeyer, and he said they would have to discontinue these frivolous, unsound practices of issuing their own credit, that they had to borrow, you know, you had to be in debt, basically. So they did fall into debt, and they fell into the depression like everyone else. And then they got a labor government that rebelled, and then the Commonwealth Bank was set up as a public bank that did public service for the rest of the century. It was a great model, but it finally got privatized. And then Otto Niemeyer also visited New Zealand, and he was instrumental in setting up the Reserve Bank of New Zealand, which was supposed to also be in this pyramid under the Bank of England, but they too rebelled. They got a social credit government in, which just issued credit, just like the Commonwealth Bank of Australia had done, and did remarkable things. They built housing, public housing, and interest-free because they owned the bank. And then the rents went back and paid off the loan. And so basically they got this housing for free. And they did many things that way. Developed, they were called self-liquidating loans, that the thing you made with the loan would pay it back as long as you didn't have this heavy interest burden. If it was interest free, it would work, and it did. But so this again, the Bank of England sent their emissary who said that they must discontinue these frivolous practices or they would be cut off from trade with the Commonwealth. So they did discontinue these frivolous practices and got into debt like everybody else. And Otto Niemeyer, interestingly, then became head of the Bank for International Settlements. So this idea of having the Bank of England at the top of the central banking scheme was transferred over to the Bank for International Settlements, something a little more apparently neutral in Basel, Switzerland. In the 1960s, there was Professor Carroll Quigley, who was Bill Clinton's mentor at Georgetown University. He wrote a book called Tragedy and Hope. He said in it that he was an insider, that the international bankers had groomed him. He was like their librarian, and he knew all this information. He knew what they were up to, but they thought it should be kept secret, and he thought it should be publicized. And he wasn't opposed to what they were doing. He just thought it should be made public. So he wrote this long book in which he said, the book was quickly suppressed, but now it's back on the market. And he said in this book that that there was this international, the international bankers had a clique that was, it was their intent to take over the world by issuing the currencies of nations and making it look like the governments had issued the currency, and trapping all these countries in debt. And that's how they would do it. And they would set up a central bank in each country. And at the head, the apex of the system would be the Bank for International Settlements. Well, that was in the 60s, where nobody had really heard of the Bank for International Settlements. So then in the 1970s, in 1971, the dollar went off the gold standard, and the dollar was losing its grip on the national reserve currency. And so a group of big bankers and Henry Kissinger got together in Sweden and decided that they would back the dollar by oil. And the way they did this was that Kissinger negotiated with the OPEC countries. This was according to the book Confessions of an Economic Hitman by John Perkins, that the way they would do this was, well, so he negotiated with the OPEC countries and said, we are going to make you very rich. We are going to quadruple the price of oil. But in return, you will you will sell your oil only in dollars, and you will put your dollars in the Wall Street and London banks, which they did. And then, so all these countries that thought they had enough reserves to buy oil suddenly didn't, because the price had quadrupled. And so they had to borrow from the London and New York banks, and that put them in debt. And that was the beginning of this whole debt cycle. Then in 2000, Saddam Hussein broke the pact and sold oil in euros, and this had to be stopped, and he was stopped, obviously. And then more recently, Libya had already, Libya was issuing its own currency. I mean, it had a central bank which was issuing its own currency, issuing its own credit. They did remarkable things for the country. They had brought water to the desert and so forth, and made it a thriving economy. Of course, they also had oil, which helped a lot. But what Gaddafi did that was, had to be stopped was that he was attempting to get the other African countries to sell their products only in gold dinar, not in dollars. And he was attempting to set up an African monetary fund that would compete with the International Monetary Fund. So he obviously had to be stopped, and he was stopped. They were not a member of the BIS, nor is Libya, nor is Iran. So you can see where it's all going now. The ideal model, obviously, for the international banking system is happening in the Eurozone, where the countries cannot issue their own currency at all. They cannot borrow from their own central banks. They must borrow from the ECB. And under the Maastricht Treaty, the ECB is not allowed to lend to the countries. It must lend to the banks. In other words, it's like the Federal Reserve. It's set up there to serve the banks. The banks can borrow at very low interest rate. Then they lend to the countries. And then the countries, if they want to borrow, have to go on the open market and pay whatever, 5%, 8%, whatever they can get, and they're subject to the whims of the rating agencies. And this is actually how the BIS keeps control, that the rating agencies will come in and downgrade you if you don't comply. I mean, these are supposedly just guidelines. They're not laws, they're just guidelines. But if you don't comply with the BIS guidelines, the rating agencies, which are private, of course, will come in and downgrade you. Then the sharks will come in and short sell your currency, and you'll be in the position of Greece or Ireland. One other point I'll make, that the BIS was responsible for the Basel I capital requirement. When this reserve requirement was getting very loosely treated by the banks, they were getting around it. And so the BIS came in with Basel I just in the late 1980s, when Japan was the world's largest creditor. And the Japanese banks were the world's largest creditors. And so Basel I, the capital requirement, killed the Japanese banks. They were more thinly capitalized than the rest of the banks globally, and that just brought them down and brought down the Japanese economy. And then Basel II in 2004 was adopted by the U.S. in 2007, and that brought down the U.S. banks, which before that had this big bubble. Basel II was the mark-to-market rule, so it's too complicated to get into, but now Basel III is going to bring down the small banks and the public banks. They're the ones that will be hurt. The Wall Street banks will not be hurt by Basel III, the new capital requirements that are more stringent. So the plan here is to just what Nathan Rothschild said 200 years ago: allow me to issue and control a nation's currency, and I care not who writes its laws. So that's the plan, and it's working, and that's where they are right now.